Perfect. We are getting into entries. Now, if you have gone over the basics and you sort of have an idea of what type of trader you want to be, then right here, this will exactly help you to get you to the right timeframes that you do want to use. I will outline the timeframes and I will outline the entry patterns, where to place your stop loss, break even, and target. After this video, are you ready to go into the market and trade? No, absolutely not. Otherwise, it wouldn't be an enrollment month, right? So we first need to finish the whole month and then we can potentially look to live trade, etc. Again, not financial advice, but that is very important to understand. Yes, you can potentially go into the market already and you can look in hindsight at entries that potentially happened that you could have been a part of. But that's the only thing you do, because after this entry video, I still need to discuss a lot more things before we can actually get to an entry, etc., etc. So that is very important to understand. Now, I've written some things down here. And the first thing I've written down is the type of entry you use depends on the time frames you are using. I will show you exactly what I mean with that. It's mainly about the time frames, about combining the time frames correctly. That's all it is. All you're doing is essentially the same thing as that you were doing on the higher time frame, and now you're paying more so attention to the time frames and where you are getting in, etc. And you're also paying attention to the time of day and the news on that particular day. So that is also very important. Now, right here, I just found it easy to use the examples we also used in the higher time frame to make it a little bit more easier, because you already understand the higher time frame of this section right here on USD/JPY. Now, what is the context again? The context here on the monthly was that we were continuing higher off of this fair value gap with that order block, right? So that gives us a context, because that gives us discount to premium array right there. In between that, that is where we want to get involved. So for example, from that low to that high, that is where we want to get involved. This is all things we touched on in the higher time frame, right? This is the boundary to now go into the lower time frame to look for a potential entry. So the way you combine the time frames, let's get that out of the way first. The way you combine the time frames is, well, first, let me go over the entry types. And then afterwards, I'll tell you immediately how you can combine the time frames and which entry type you want to use depending on which time frame you are using, okay? So we have an ST entry and we have a re-entry. The ST would be the first entry and the re would be the second entry. I know there's also an offset entry. I'm not going to discuss it here. I'm only going to discuss ST and re entries right now. We have an ST entry and a re entry. An ST entry is just what we saw, right? It's just a simple ST entry. The re entry is when order flow is confirmed. I'll show you examples, don't worry. What you want to do is when you have a monthly PD array, you want to use the 4-hour for your re-entries and you want to use the daily for your ST entries. So you can see the lower you go for your entry confirmation, so the lower time frame you use for your entry confirmation, the more confirmation you are going to need. So the higher the time frame, the less confirmation you are going to need, because in a daily ST, there's already a 4-hour read that happened most likely. So that is how you need to combine the timeframes and see, all right, if you want to only use an ST entry, that's perfectly fine. But just know that you need to combine the timeframes correctly. If you are using 4-hour STs for monthly PD arrays, then you will likely take a lot of hits before you get the right move. That is very dangerous. Now, in that 4-hour ST alone, that is where we can have 5-minute entries already, right? That's what we talked about. So let's go over a weekly PD array. In a weekly PD array, you either want to be using 1-hour re or you want to be using 4-hour STs. So 1 4-hour ST or a 1-hour re. In a daily PD array, you want to be using either a 15-minute re or a 1-hour ST. And the important thing here is that you can also use a 4-hour ST. You can also use a 1-hour re. as long as you don't go lower than a 15-minute re. So don't use the 5-minute, don't use the 10 minutes, don't even use the 14-minute. At minimum, these are the minimums. So at minimum, we want to have a 4-hour re, a 1-hour re, or a 15-minute re for these PD rays. We can get creative and we can say, all right, I also want a 1-hour re instead of just a 1-hour ST. Perfectly fine. You can do that as long as you don't go below the minimum of the re's. So the 4-hour re for a monthly PD ray is the absolute bare minimum that you need to have. Weekly PD ray, 1-hour re is the absolute minimum. So not a 30-minute re. Daily PD ray, the absolute bare minimum is a 15-minute re, what you need to have. So a 4-hour PD ray is what? A 5-minute re, that is the absolute bare minimum again, or a 15-minute ST. Again, you can get very creative because you can also do a 15-minute ST plus a re, right? But that is all things that you can eventually do. Let's just stick to the basics right now. These are the basic entries. Now, this is for your filtering process. When you are using a filtering process trading plan, which is essentially you're always looking to find the highest probability instrument and you're trading that for that particular day. That is a filtering process trading plan. Again, there's all things we will go over, etc., etc. Right there, then you always want to be using a 4-hour PD ray as a minimum. Minimum, a 4-hour PD ray. You don't go lower than the 4-hour if you're using a filtering process trading plan. Now, if you're using a flow trading plan, it's a little bit different. If you're using a flow trading plan, meaning a flow trading plan is where you only focus on one instrument. You don't analyze anything else. All you're doing throughout the week, throughout months, throughout years, you only focus on mastering one pair, one instrument. So for example, only EU. You don't switch. That's important. You don't switch from EU to GU the next week to USD Canadian dollar the next week. No. You stick for years and years with the same exact pair or the same exact instrument. For example, ES. But don't switch between ES and NASDAQ. You only focus on one of them. You don't switch between them. Very important to understand, all right? So what you then can do if you focus on one instrument alone, then you can use 1-hour PD rays because you have more time to analyze that one instrument. You're more so aware of what's happening. If we're going through 20 pairs or 20 instruments, we don't have the time to go over the 1-hour PD rays. And even if you had the time, that's not what you want to do because that is absolutely detrimental. That is not good for your brain. That is too much information to take in. That is not good. That will not benefit you at all. That is where less is more comes in. It's not beneficial. Again, believe me, I've tried and I'm always talking from experience. So it's very important to understand that. So that is only for a flow trading plan right here. And then, of course, with a flow trading plan, it doesn't mean that you dive into the 1 hour straight away. No, you still use the monthly, weekly, daily 4-hour, but then you can go into the 1 hour. For a 1-hour PD ray, what you would do, the bare minimum is a 1-minute re-entry. Then we also can use a 5-minute ST entry. If you were to use 15-minute PD rays, which is the lowest I would go. 15-minute PD rays is the absolute lowest I would go. Then you would use a 1-minute re or a 1-minute ST is perfectly fine. That is again dependent on how far the next PD ray, the next 15-minute PD ray is. But a 1-minute re, 1-minute ST is perfectly fine right there. Again, that is all PD rays talking about PD rays that are part of current order flow. So every PD ray that I'm talking about here is part of a current order flow. Remember the checklist that we had. If the PD ray is not in current order flow, then of course we need to wait for something to align again on the higher time frame, on our context time frame. Because the PD rays, those time frames are your context time frames. And then when those are your boundaries before you go into the lower time frame to look for an entry. So it's always a boundary. We have a boundary, a context time frame first, and then we have an entry confirmation time frame. That's the second one. So there always needs to be a boundary. So You will never see me take a 5-minute re out of nowhere. No, there always is a boundary before I go into the lower time frame. So before I use a 1-minute ST, 1-minute re, whatever, or 1-hour re, there's always a context behind it. There's always a PD rate. There's always a boundary. That is very important to understand because that is crucial to your trading plan. If you don't have that and you go into the 5-minute just on a random time of day, then of course you will take every 5-minute re. You will take every 15-minute ST. Just in the middle of nowhere. It doesn't make any sense. You need to have a boundary. That is very crucial to understand. All right. So right here, what we can do is anchor this really quick, and then we will go over the exact entry models that we will be using. So here in the top right, we have it as a reminder. Then right here, what we can do is we have the monthly fair value gap towards that monthly PD rate. So what do we have? We have context. Then we can go into the 4-hour to look for a 4-hour re or a daily ST. Now let's dive into the 4-hour first. This is again the basis of every single model that I am teaching. Again, I will show you with different trading plans how you can get very creative, but this is at the basis of every single trading plan. So right here, we have a monthly PD rate that we're coming off of, and then we need a monthly re. What is a re actually? Let's define a re. A re is where order flow is confirmed. That's all it is. So what do I mean by that is we first have an ST, right? That's what we went over. We have this ST, displacement in, displacement out. That is our ST. We don't need market structure shifts. We don't need anything. We just need those fair value gaps to tell us what it's doing. Fair value gap in, fair value gap out. Then we wait for a new order flow leg to get confirmed off of a previous discount array. Can be any discount array. Doesn't have to be the fair value gap. Can also be the breaker. Remember the PD array matrix that we went over. We have a breaker. We have fair value gap right there. And we have that low right there. That's the only PD arrays that you need right there. So any one of them can push price higher, can displace price higher with a new fair value gap. And that right there is your new order flow leg, aka your re-entry. So what you can do right there is you either have a rule where you enter off of the first discount array that we encounter or the overlapping discount array. Again, the type of trading plans, whatever, we will all discuss. This is just going over the very basic entries. And that is why I need to emphasize on the fact that after this video, you are not ready to go into the market. Absolutely not. So that is extremely crucial for you to understand. I'm sorry I keep on saying it, but it is what it is, right? So right here, what is the first discount array that we encounter? Well, we have that fair value gap. I like to personally enter on fair value gaps, but the first one is actually that order block, right? Or we can enter on the overlapping part and that fair value gap right there. What would you cover? You cover the place where price has no reason to return to. So where does price have no reason to return to? Does price on a PD array matrix basis have a reason to return to this fair value gap right there? Yes, of course. So you won't cover your stop loss right there, right? Does it have a reason to come to that order block right there? Yeah, of course. Does it have a reason to come into that low? No, it does not. It does not. It's not high probability for it to do that, but it can do that. That is important to understand. It can sweep that low because, again, remember order flow. Order flow, once this low gets swept, order flow is still intact. So it can do that. Is it a high probability? Absolutely not, because we have a fair value gap in it, in that leg as well. So it's not high probability, but again, we need to take into account it can sweep it. That is very important to understand. So an intermediate term low covering right there, there's nothing wrong with that. Why not? Look at the target that we're having, because your target is the first thing that you actually establish. The target is the easiest. That's just a monthly premium array. That's your target because you're trading in a type of context. Now, again, are you always targeting that ultimate context high or ultimate context low from whichever PD array you're trading from? No, that's not something I would advise. In the meantime, you are already taking into account that you've gone break even, I would always advise you're starting off with 1 to 2 RR. Whenever you get into a trading plan, whichever trading plan you want to use, you are going for a 1 to 2 RR. Afterwards, based on data, based on the things we study, etc., we can go aim for more potentially. But start off with a simple 1 to 2 RR. That is more than you need. It's more than enough. So a 1 to 2 RR, perfectly fine. If you want to target for more, eventually we can look into partials, etc. But personally, I'm not a big fan of partials. I just like to get in, get out fully. So right here, 1 to 2 target. Perfect. 1 to 2. Not that difficult, 1 to 2. Then afterwards, when do we go break even? Because now we're in the trade, we experience some drawdown there, which is pretty scary, right? When do we go break even? You purely go break even based on the order flow lags. Can you see now that that everything at the core of our trading plans is order flow? Everything is order flow, combining the time frames. It's all coming back. What we've done on the higher time frame is all coming back. Now, right here, this is exactly where you would go break even. We have this new order flow lag higher right there. There's no reason to actually come back below that low, but we can right there. We can come back below that low again, just like we saw there. But if that does happen, again, then it would need to sweep pretty far based on order flow. There's no real reason to come back right there. And that is also where you combine the time frames correctly. Because when we have this order flow lag right there, remember what we did on the higher time frame. Would you take a trade off of this order flow lag? That's a question you can ask yourself. Would you take a trade off of this order flow lag? Maybe. What's the maybe? Well, if there's a daily fair value gap hovering below this order flow lag, then no, I would not like to take a trade off of that. Let's see. There's not. Perfect. So that is a place where now we can officially go break even right there. So that is important to understand. You look at the time frame you entered on, and then you follow the order flow lags, but you still take into account the time frames above it. Is there a daily fair value gap below that order flow lag? Is there a weekly fair value gap below that order flow lag? That is all things that you need to understand, right? That is very important. And that is, again, just based on that higher time frame, all that we've done. Now, right here, we entered on a 4-hour re. And what I mentioned in the checklist, you can also enter off of what? A 4-hour ST when we've already hit a monthly PD rate or any PD rate that is there, and we have a 4-hour ST. Again, for the checklist, go back to the higher time frame videos. We have a 4-hour ST, then in that 4-hour ST, you would use a discount array. For example, that at the right time of day, in London right there, at the right news day. Again, I can't see if that's news day right now. And then you will go into the 5-minute to look for a 5-minute re or a 15-minute ST right there. So let's actually see if we do get something right there. We have our, let's see, we have our ST here. Then right here, we have a new order flow lag higher. That is your re right there. Where do we place our stop loss? Let's see. On the time frames above it. Is there a reason to come back here? No, not really, because order flow is also continuing here. So this 50-minute order flow lag just continued higher right there. Is there a reason to come back to the 1 hour? Not really. It's still in the making right there. So that low is indeed fine to place your stop loss right now. Now you can, again, give it some room because the 1 to 2 is easily reachable before we take out that high. Easily, right? So give it some room. You don't need to suffocate your stop loss to get 100 RR. No, you can give your stop loss some room to breathe because a 1 to 2 is easily attainable right here. No worries at all. Again, the important part to understand right there is that the higher time frame is always doing the work. So you can see the entry models are pretty easy. They are really easy. Like the entry should be the easiest because during your entry, there will be a lot of emotions, a lot of minds, a lot of voices in your minds telling you, ooh, should I take this entry? Should I do this? Should I do that? That's what we want to avoid. How can we avoid that? By having guidelines, simple guidelines to getting to an entry. The hard work, when you have absolute mental clarity. Your mental is at your best. Your mental capacity is at your best when you're doing the higher time frame work. When we get into entries, your psychology will take hits. It will be very tough to keep your mental strong and to actually enter. Since it's so simple, we don't have a lot of issues with that. That is very important. And whilst the stress is gone, that is where we can do the hard work. So that is where the higher time frame comes in. So the higher time frame is always doing the hard work for us. And there's a reason behind that. Everything that I'm teaching here, there's a reason behind it. There's a thought behind it. Always a reason behind it. The whole simplifying, there's a reason behind it. There's a special episode. We are going to touch on why we simplify in the first place. How you can simplify potentially. It's all very important. So there's a reason for every single little thing that we do right here. That is very important to understand. Because, and I'll try to explain the reasons as well, because I know a lot of people like to have a reason why we do certain things as well. And the reason why the entry model is very simple is because during live trading, you don't want to do the hard work when you're under stress. You want to do the hard work when you're stress-free. When you're stress-free is when you are doing the hard work on the higher time frame. You're just simply analyzing. Analyzing is chill. You don't have a lot of stress. That's why a lot of people can be great analysts, but they really can't trade because they can't handle the stress, because they make the entry too difficult. You can just have simple guidelines to get to your entry, then there's no need to worry. And that is why the next week is psychology, etc., etc., etc. See, you're not really ready to trade live just yet. Not just yet. After this month, again, we can take another look. Not financial advice. So right here, this is what you want to do. And again, because you're doing the hard work on the higher time frame, I always tell people, just get in. So you pick an entry model, stick to it, and just get in. The entry model is not where the difference is made. The difference between your net return, between your win rate, is done on the higher time frame. It's done on your analyzing phase. It's not on your entry model phase. That is very important. It's not in the execution phase, not at all. And again, it can be if you are making it detrimental to yourself and you're suffocating your stop loss and all the time you're getting taken out and then it continues higher. That is where it can be detrimental, of course. But we just want to get in. You want to get in. You want to reward yourself on the patience you had, on all the hard work you've done on the higher time frame. So don't suffocate your stop loss. Please, very important. If you think, all right, if you think during a live trading session, you think, I'm not sure it might get swept that low, then just place it a little bit lower. This your stop loss is perfectly fine. And then, of course, if you can easily target 1 to 2, then of course, that's also another reason to just don't suffocate the stop loss. So that's very important. Now, for the people that were paying attention, what did we also see? A 15-minute ST entry. And what is a 15-minute ST entry? A 15-minute ST entry is a very simple ST entry right there. As long, again, it meets the criteria of an ST. An ST needs to have a fair value gap higher right there. So if that fair value gap higher wasn't there, then of course there was no trade. But sometimes you can also take an ST entry off of a breaker where you, for example, let me go up in time frames again. And right here, let's say, again, this is not a valid entry, but let's say we were to take an ST entry off of this ST higher, then this could have also been an entry right there off that breaker. But keeping in mind that this fair value gap needs to be there. There needs to be a fair value gap higher. That is the main criteria. That is very important. So when we dive into the 15-minute again right there, what can we see? Then we also have this ST entry. And then your stop loss is pretty easy, right? You're just covering the potential intermediate term low because you're trading your potential intermediate term low. This is confirming order flow right there. And then you're targeting again a 1 to 2 right there. And that is how you can go from 5-minute re, or you can look at a 15-minute ST right there. During the right time as well, right? Because before we look at entries, so high time frame is checked off, etc., then time and news needs to be checked off. Now, again, I just want to show you the entries here that we're using. Time and news is things we will also go over. Sorry about sort of keeping it vague that way, but it will click, click, click more. It's a step-by-step guide to get you to that place. That is very important to understand. So let's continue right here. We have seen monthly PDRA, 4-hour RE, daily ST. Now, that is funny because the monthly PDRA, 4-hour RE, daily ST, if you were a position trader, then we could have taken the same trade if we were a day trader or even a scalper. See how funny that is? Because if we even go into the 15-minute PDRA and we were trading only USDJPY right here, and we had a flow trading plan. So we had a flow trading plan and we only focus on USDJPY. Again, I will make a separate video on the flow trading plan as well. Right here. Oh, I can't go that far back. That is unfortunate. All right, no worries. But I think you all saw what I was trying to do. That if we go into that 4-hour ST right there, because we can go into the 4-hour ST to look for confirmation already, not to take a trade, but to look for confirmation on the lower time frame already. Then right there, we could have gone into that 15-minute fair value gap right there, and that could have been a 1-minute RE/ST. So essentially what you're doing, you're always trading something on the higher time frame, right? The only thing is you're confirming it on the lower time frame constantly. That's all you're doing. So that is why if you're scalping, then again, this is important to have everything in context. It's all important. And when everything is in context right here, when you take a 1-minute trade right there, that is the highest probability 1-minute trade that you will ever take in your life. If you can consistently take trades like this, where we have a mechanical step, monthly PDRA to monthly PDRA, we have the context, 4-hour ST, inside a 4-hour ST, we have a 15-minute ST, and then we have a 15-minute PDRA, 1-minute RE or 1-minute ST. That is a guaranteed 90% win rate if you can consistently find that. Now, will they happen very often? No, because that is where we need to find the high probability price action again, right? So that is very important. So if we go on, then eventually we had the 4-minute RE. Now, how far can you actually follow the 4-minute REs entries? Because a 4-minute RE entry is exactly, it's in the name. A RE just stands for a re-entry. So you're constantly re-entering the market. How far can you follow re-entries? You can keep on following re-entries essentially. You can keep on following the order flow legs until we take out those highs. But keep in mind that the 4-hour here needs to be in context of the daily. So when the daily is creating a daily fair value gap right there, it can retrace into it and even have a bigger retracement right there. Whilst on the 4-hour, that is again where you would more so use structure. And on the daily, it's just order flow, right? So that is where you need to, again, take into account that context that you don't want to enter right here because we might just reach for a daily fair value gap right there and it takes you out right there. So that is why you always want to have them in context, because then you're always entering on essentially the lowest discount array. And when you're entering on the lowest discount array, price usually doesn't have a reason to retrace back to your stop loss unless your whole bias is wrong. So that is exactly what I love about that as well. Then if we move on, we had a daily ST. So the daily ST, that could be an entry right there off of the monthly PDRA. And that could be our target right there. Your position trader, very nice. Now, then we have a new order flow leg higher right there. Of course, a daily RE after a daily ST, nothing wrong with that. That could even be an entry right there. Targeting those highs, perfectly fine. That could be an entry. Now, again, I'm saying that could be an entry. I'm just showing you the entry possibilities. You will pick your poison eventually, as in you will get to an entry plan and you will stick to the entry plan. You will not be taking every single trade here that is showing itself. No, no, no. That's also not what I'm doing, right? I'm just showing you the entry opportunities that we can have and the entries itself. So focusing on the RE and the ST. That's very important. So afterwards, what do we see? Well, right here, we have this daily order flow lag and we have a fair value gap and we have an overlapping part. So that is where we can look for a potential entry. When? At the right time, at the right day. Again, that is things we will go over eventually. So daily PDRA, 15-minute RE or 1-hour ST. All right, interesting. 15-minute re. Let's first take a look at the 15-minute re. Now, right here, you can already disregard everything that is happening here because this is not at the right time. This is Asia session. It's not where you want to be entering. So eventually, what are we seeing? Well, we are continuing higher right here. We are having a new fair value gap higher right there. And then we have a new fair value gap higher in London as well right there, which is nice to see. So we are creating a re-entry there with a new order flow leg higher right there in London. Is this a great entry? And I want you to answer quickly. You haven't seen, maybe I'm cheating because you haven't seen the other time frames. Is this a great entry? Not really. Why not? Go into the 4-hour. What are we seeing? There's a 4-hour fair value gap just below that. So in this case, what would you do? You would not keep on following the 50 minutes, just like we just saw on the 4-hour and then the daily fair value gap, like we just saw here. You would not keep on following the 50 minutes because we have a 4-hour fair value gap just below that 15-minute order flow lag. So again, it's a low probability that 15-minute order flow lag. So what would you do right there? You would use that 4-hour fair value gap right there. Or you can still use a 1-hour ST. Where is your 1-hour ST? At the right time, we have this fair value gap higher. This is not in London just yet. So this right there is a perfect entry. Why? This is no order flow lag higher, right? So this is still your order flow lag. What is the fair value gaps in this order flow lag? That fair value gap and that fair value gap. So that is still a perfect entry right there. Covering the lows, targeting the highs. Again, just doing the same thing on a different time frame. That's all you're doing. You're just combining the time frames correctly. It's all you're doing constantly. And it's beautiful because you can name every concept that you can think of. Macros, power of 3, whatever you want. Whatever, it's a Reaper fair value gap or whatever you can think of. Every single concept is already involved in just this simple PD rate to PD rate, the context, 5-minute re, 15-minute ST, whatever. Everything is already involved here. Everything. That is also very important to understand. And again, in the simplifying video, that is where we'll dive into that deeper as well. So you use the 4-hour fair value gap right there or a 1-hour ST. Now, if we dive into the 4-hour fair value gap right there, what can we use? We can use a 5-minute re or a 15-minute ST. Now, let's actually use the replay tool here. We come into it right there during the right time. Yes, during a kill zone. Perfect. We watch for a 15-minute ST or a 5-minute re. Let's just focus on a 5-minute re. And then during the 5-minute re, we will likely also have a 15-minute ST. All right, perfect. And you can see that if you don't combine the time frames correctly, if you're just using 5-minute ST of a 4-hour fair value gap, you will take a lot of hits like that before you get the entry correct, before you get the move correct. That is why the time frames are so important. So the time frames are giving us the confidence right there that it does want to move higher. Because on a 4-hour basis, what is happening? Candle science right there is respecting it, but we can already view that by going into the lower time frame right there. Here we have the 15-minute. Hey, we are creating a fair value gap. On the 15-minute, this could already be an entry right there. Risk management, why do I cover the bodies right there? Well, the bodies are, this is also purely based on candle science, very long bodies right there. You could do this, again, based on not suffocating your stop loss, etc. You could do that, but the bodies right there are also perfectly fine. There's already a big aggressive reaction. And again, that is why I choose the bodies over the wicks right there is not 100% objective. You can say it's based on candle science, but right there, it's just a little bit eye to detail where we have long bodies right there. There's no real reason to come back to those wicks. If it's taking those bodies, it's also likely taking those wicks. If we had very long wicks as well, then it might also be a great opportunity to put them under the bodies right there. So that is what you'll see me do most of the time. Now, right here, we can come into the fair value gap and then we can continue higher off of that. Targeting what? A 1 to 2. Now, this is where it gets extremely fun, because if you gather the data and eventually over time, when you're more advanced, so maybe in a few months down the line, what can you do? You're in a 4-hour context towards this high. But what else? Well, we are also in a daily context towards this high. That high. What else? Well, we are also in a monthly context towards that high. That is extremely high probability price action right here. Now, is the target extremely high probability? Not extremely high probability, because there's a good chance that when you try to enter these type of trades, what will happen? You'll likely take a lot of break-evens before they eventually play out to find the right context. So again, that is where the same story comes in. How many hits are you taking before you get the right move? We don't want to take any hits before you get the right move. And that is what I'll touch on in my particular trading plan, in my personal trading plan in Delirium. The name is Delirium. And I don't take any hits before I get in the right move. As in, if I take a loss, break even, win, doesn't matter what happens, I take one trade that singular day. That's all I do. If it's a loss, I don't look to re-enter. If it's a break even, I don't look to re-enter. I take it on the chin and I move on to the next day. Don't look at anything else anymore. So this, again, this is where you can get more and crazier with targets. So eventually, with data gathered over time, if you first can just get funded with a 1 to 2, that is our first focus. We need to get funded with just focusing on a 1 to 2. Then eventually, when we grow maybe a personal account and we want to take these trades as well, and we have a copy trader going on, and on one of the accounts, we can look to target more eventually. That is how we want to approach that. But first, if we don't have any consistency yet, we don't have a funded account yet, we focus on just simple 1 to 2s. That's all we're doing. So right here, what are we doing? That is your target. Right there. Does it eventually get hit? Yes, perfect. So right here, of course, after this new order flow leg higher right there, you want to be break even as well. On the 5-minute, what are we seeing? The 5-minute right here, we had an ST right there. And then afterwards, we have this right there. Can we cover this low? 50-minute. No reason to return on the 50-minute. Not really, because 50-minute also stings into that. So if order flow wants to continue higher, we'll create a new Verweij gap right there. 1 hour is still in the making. So yes, you can indeed cover this low. You can right there. With, again, 1 to 2, perfectly fine. Perfectly fine. So this is how you can get, well, very creative. Eventually we can get very creative, and these are the basic entries, what we're doing all the time. So on a weekly PDRA, we would just do the same thing, 1 hour re and 4 hour ST. We're constantly doing the same things. Now, if we follow along with price action, again, when we reach above that high, what do we need? We need what? New context, right? So if we need new context, we again, because we're using a filtering process trading plan right here, we go over the 4 hour and we need a new 4 hour discount rate to take trades from. Perfect. Right there, 4 hour fair value gap right there where we can take trades off of. Then we go into the 5-minute to look for a 5-minute re, or we go into the 50-minute to look for a 15-minute ST. At the right time, at the right day, you know it. And again, this is again the same reason why you would not take a 5-minute ST. You're going to take a lot of hits. We have our ST right there. The only thing we now need is a new discount, is a new displacement higher. We have a small displacement higher right there. Now, again, this is where we have, I always preach, we have 80% mechanical, we have 20% intuition. Yes, you can be fully mechanical. Will you take more losses being fully mechanical? Absolutely. And that's why a lot of times being fully mechanical is absolutely detrimental. And what I mean by that is because intuition and just also somewhat of a logic is that that will save you a lot of trades. It will save you a lot of losses, etc. And it will get you more wins, more return, higher return, and a better win rate. Because that 20% intuition That is where the potential is. Now, why do we have 80% and 20%? Now, I don't know if you know the 80-20 rule, but that is perfect in harmony because one is supporting the other and they are both not detrimental to each other. If you're just trading off of intuition, it's going to be detrimental. You're not going to get anywhere. If you're just trading off of mechanical guidelines, it's going to be detrimental most likely, and you're not going to get anywhere. Now, it doesn't mean you can't do it, but fully mechanical, fully intuition, that is likely not where you will see great returns, not a great win rate. That is just not what you would want to do. So for us, retail traders, we want to focus on being 80% mechanical, 20% intuition. And you need to understand, the potential lies in the intuition, not in the mechanical approach. Yes, we can change a few things here and there, but we need to stick to a guideline that we have set out. So eventually at the end of this enrollment month, we have a guideline that we have set out and we have some kind of mechanical step-by-step approach to the market. Once we have that, then it's just waiting for intuition. And that is done through journaling. Again, all things we will go over. But that is very important to understand. And the reason why I bring this up and why I mention it right here is because this is not a trade I would take personally. And sometimes it's difficult for me to explain why. And the reason why is because I just have more time. I just have more time behind the charts, way more time. My intuition has already taken over. So I sometimes avoid certain trades that other people would take. And sometimes I tell people, yes, from a mechanical standpoint, it's a perfect trade. From an intuition standpoint, I do think that we have something to work on right there. As in, again, that is also saying that no, I'm not taking a loss, for example, and I'm going into the charts and seeing, all right, what could I have done better? No. You just take the loss on your chin. But again, you keep in mind that if we have certain price action right there, because you do gather data on it. And when you gather data on it, it also sticks to your mind when you have a consolidation like this. And we're not expanding higher immediately after the ST. As in, we have an ST and then we consolidate. Is that high probability? No. And again, that leads me to being very picky about my price action. But this, a mechanical standpoint, is that a valid trade? Yeah, it is. Is it a good trade? I don't believe it's a good trade. Not just because I got taken out, because we had a consolidation right there. Don't think it's high probability at all. Because you could see the entry we had before that. Look at the difference. When we have high probability price action, it's quick. And that's the reason why I tell people you will have less high probability days than you will have low probability days. And again, that's not because we are very specific. We're not really that specific. We don't have a lot of rules going on. Really, we don't. I've seen trading plans that have a lot of rules, but we don't have a lot of rules. It's just the nature of the market. Because when there's high probability price action, price delivers quick. It doesn't do it slow. It's quick. See how slow this is? And slow price action already takes so much more candles. Whereas high probability price action delivers quick. Quick to your target, boom. That is high probability. Way less candles. Low probability and low probability price action. How long did it take right here? How long did that take? Now again, we can also include until we reach the 4-hour PD ray. It took about 9 hours. Let's say 9 hours. How long did the high probability price action take? Let's say from when we touched the 4-hour Fairvalue gap towards the high. 3 hours. How long did the low probability price action take here? About 9 hours again, actually. Well, before we touched this PD ray, we did about 15 hours. That is where people mess up. Because they can make profits. Everyone, every person in the world, my 4-year-old nephew, I could get him to the chart right here. I could show him this and he can make money. He can make money. Literally, he can make money. But waiting a whole 15 hours after you even missed this, or even after you suffocated your stop loss on a setup like this, you suffocated your stop loss right there. And then waiting another 15 hours before you get a new opportunity where you potentially take a new loss, a new break even. That is detrimental. So it's not the high probability conditions they are not that difficult. Not at all. It's waiting for that new high probability conditions. Those are difficult. And that is why I tell you, the high probability conditions, they don't last long. 3 hours right there. And not even 3 hours, because you, of course, in those 3 hours, you don't always have an entry opportunity, right? You just have them there, and right there. There's 3 entry opportunities right there based on the 15-minute as well. So I'm not taking into account this 5-minute ST. I'm taking into account the 15-minute ST. And then 1 5-minute re and a second 5-minute re. That's all the entries you have. So that is extremely crucial to understand as well. So again, is this high probability? No, this is already taking 3 hours. This is taking just as long as this trade did to hit take profit. Just take that into account. Now again, that can be objectified, but that is very difficult in a sense. And that is where you get, where a lot of people, they try to objectify it and they just make 1,000 rules and they can't really get to a trade because they have 1,000 rules, etc. That's not what you want to do. So yes, this is a trade. I went on a little rant. It's a loss. Perfect. This could also be a trade. What would you cover? Again, that low, because there's no reason to cover these lows right there. This low. There's no reason to cover that low, right? Because there's no reason to return right there. So right there, eventually, what do we see? Another loss. Perfect. Then eventually you will see price delivers towards the highs. Now, after taking that many losses, would you take these trades? I personally don't think you would. And the reason why is, again, risk management, which is a separate video we will also go over. Now, to top it off right here, we have also a 15-minute ST, which would have avoided the loss. And again, that is picking your poison, because sometimes the 15-minute ST will take a loss. Sometimes the 5-minute re will take a loss. It's, again, picking your poison. There's not one better than the other. The only thing that can be better is someone's intuition. That can be better than the other person's. That is very important to understand. So when you see someone absolutely smashing it, it's likely that they can't even, to a certain extent, yes, they can teach you it. But that 20%, again, that is where your own work comes in, your own experience, etc. Again, I can give you tips on that. Don't worry. We will get into that. It's not like I'm saying you can't do it. No. No, absolutely not. The mechanical part, yes, perfect. The intuition part, it also takes time. So you have to submit to time. That is also very important. And that is where the lessons come in the breakdowns, in the forecast, eventually where we have intuition lessons. And now we're focusing on the mechanical part. Very important to understand. All right. And then we also, of course, have these, but I think the message is clear on the entries. We have an ST and a re. This is how you combine them. This is the minimum, again, because we can also take this 15-minute ST plus re right there. But the minimum is a 5-minute re right there. That is very important to understand. And then eventually, of course, this in itself on daily could also be an entry, right? This in itself could also be an entry where it delivers to the monthly context right there. Because again, you don't need that 1 hour ST. You can also use a 4-hour ST. It's even higher. And a 4-hour ST plus a re right there in a daily context. Extremely high probability right there. So that is also something that you could do. And you can get, again, very creative with this as long as you understand the simple principles that we do have. This is the minimum. Don't go below that. That is very important. All right, then tomorrow and the rest of the week, we will touch on this more and more advanced to get you ready for the live environment, to get you funded, to get you some assets. That is our goal, to make some money. Again, not financial advice. Don't sue me, but that is our goal. All right, perfect. Thank you.